Big tech's earnings are underway, with results expected to test the recent rebound for the sector. Here to discuss the expected winners and losers of this season's quarterly results, we've got RBC Internet analyst Brad Erickson. Brad, great to have you here with us this morning and to get some of your insight going into the wave of earnings, the slew of earnings that are going to be coming out from some of these formerly high-growth internet names. I know we've discussed that in the past. Is this the quarter where we discover whether or not there is still high growth in the future?
No, I think it's going to be more of the same. And certainly when you think about, where numbers are going to shake out for Q4, you look at names like Meta, like Google. I mean, we're looking at year-over-year declines actually in their core businesses. So I think people are optimistic as we look towards maybe the second quarter and the second half of the year. But I think for the moment, you're going to hear a narrative of caution and headwinds, particularly as we start out 2023.
And going into 2023 here, though, Brad, your top pick is Meta. And there are a lot of dark clouds hanging over that stock. But it seems like, judging from your note, that's exactly why it is one of your top picks. I mean, is all of that priced in at this point?
Well, I mean, the stock's bounced. I think a lot of it, I think actually in retrospect, we've been making this call since coming out of earnings, frankly, that we liked Meta as they look to restore a lot of that signal that they lost from the Apple software changes a year and a half ago or so. We think they are making improvements in terms of targeting and measurement, and we think that's translating to some incremental dollar growth and advertiser spend. Some of that's reflected into the print, is what I'll say. The stock has gotten a little bit more crowded, particularly in the last month or two. So the setup maybe into the print, not quite so interesting, but in general, yes, structurally, we like the fact that they are restoring that signal and think that can carry increasing tailwinds as we move through 23.
Brad, you mentioned in your note that estimates on Snap look washed out. Does that mean you buy Snap into earnings really on the thesis that it can't get any worse for this company in terms of guidance?
Yeah, so just to be clear, from a rating perspective, we are sector perform. So obviously, I got to be a little careful there. But tactically, yeah, I think Snap in particular has come out with, they announced some cost cuts a couple quarters ago, pretty substantial cost cuts into 2023. And I think as we look through street models, I think we wonder if that's totally reflected, meaning that has the potential that earnings estimates need to move up directionally from here.
Where are you seeing, and within some of the names that you say have bottom line upside potential, you're talking about Uber, the aforementioned Snap as well, DoorDash, even Meta, and the list goes on. What is it that are some of the catalysts that all of those companies are being able to really benefit from in terms of it trickling down to their bottom line?
Yeah, I mean, I think there's a couple of aspects, right? You just go through the P&L. Variable cost structures in these businesses are fairly set, so there's less you can do there. It starts with sales and marketing, right? You can cut your ad spend. Typically, we're finding that companies tend to cut more brand advertising spend because the payback period, I should say, is longer, right? They need direct response ad spend, so you can't cut as much there, but brand spend definitely got cut. And then obviously the kind of a daily unfortunate announcement of layoffs, right? Headcount reductions. A lot of these tech companies that benefited hugely during COVID, obviously part of that was business momentum, but then part of that was they were all looking to invest in new opportunities, right? When times get a little tougher, like what we're in right now, you kind of have to pull back on some of those speculative sort of exploratory investments that some of these companies are doing. And obviously that's been translating to bottom line upside for some of these, and we think can more so here in 23.
Brad, speaking of layoffs, we had a little debate here at the top of the show about those at Alphabet in particular, and whether they're the result effectively of mismanagement and whether the layoffs themselves have been mismanaged in the way that they've been carried out. What's your take on that?
Yeah, I mean, first in terms of how the company was run, and I think what I just mentioned definitely is what's going on with Alphabet, is that their business exploded. We all know that during COVID, very self-explanatory. They had to hire more people. What's interesting, though, and I think if you read between the lines in the 8K they published around the layoffs a few days ago, is that their they're working on a lot of new projects that are sort of the future of the business, i.e. maybe a competitor to something along the lines of ChatGPT you were just speaking about before this segment, right? And so the question is are these layoffs more a reflection of incremental business weakness, or are they areas that they can pull back that were sort of more speculative 3 to 5 year out type science projects? We don't know the answer. I do expect probably more clarity around that on the earnings call. But I think they're unfortunately they're trying to meet investor expectations around margins and bottom line. There was a lot of concern around that. They knew, I think, they needed to do something, and that's why they pulled the trigger there.
Just kind of bringing this to a circular ending and ending on Meta, and one of the biggest impacts there continues to be the overhang with TikTok as well. TikTok is going to be making some changes reportedly to try and get more fanfare among U.S. regulators to the extent that they can woo U.S. regulators. But is that transparency push from TikTok something that Meta platforms and particularly Instagram underlying within there, does that still prove, and is that still the larger overhang risk, is that you have so many of the young consortium that still would use this platform and regulators then that may come around to allowing TikTok to just continue to operate as is or with these new mechanisms?
Yeah, I think we've taken the stance that we think the likelihood that TikTok gets banned from the App Store or whatever seems pretty low. Just all sorts of other unintended, probably adverse consequences and issues associated with that. But obviously you've seen things like, federal organizations, colleges, et cetera, removing the ability to access TikTok on their Wi-Fi networks, things like that, right? So that's sort of self-explanatory. I think the bigger issue, frankly, as an overhang for Meta's stock is just simply, it's two things. It's user engagement, and it's how well advertisers are finding value at using their platforms. And I think if you just look at latest trends, what I'd tell you is TikTok user engagement plateaued in the US about 5 or 6 months ago. And on the advertiser spend, I think what we've heard is that advertisers are sort of saturating the audience that they've spent on at relatively lower levels than Facebook, for example, or Instagram. And so there's a limit to how much you can spend. Maybe you take 5 or 10% of someone's budget, but they're not taking 40%, for example. A big bulk of it still goes to Instagram because the audience is so much bigger and the ability to scale spend there is so much bigger. We haven't heard changes there. So we're actually sort of relatively more positive on Meta versus TikTok right now, just in terms of the competitive trends we see in the market.
And Brad, out of all the tech stocks you follow, what names do you just take a step back when looking at their models, looking at their business position, that you wouldn't touch with a 10-foot pole?
Woo, that's a tough question. I think there's a lot of names in our coverage that are bottomed out, whether they were SPAC names or just in general, they've not been able to generate cash. We can argue whether those have found sort of a sentiment bottom and you get a little bit of a dead cat bounce. If you're not generating cash, if you've got heavy stock-based comp relative to your actual earnings, those, I'm not going to name names, but those would be the companies that would easily fall in the don't touch them with the 10-foot pole category.
Brad, I'll shoot you an email after this segment, but we appreciate you and we appreciate that answer. RBC Analyst
Tough one.
Brad Erickson, we'll talk to you soon. Appreciate seeing you.